Hello, friends. Today we're taking a look at Cisco Systems, ticker symbol CSCO. Cisco recently had a big drop of almost 11% after earnings. They are close to their 50-week two lows, and this is a good time for us to ponder the question, is it time to buy? Is it time to consider Cisco as part of to be added into our portfolio? Um, Analysts are thinking that in the next 12 months, it might get to $58, which will be a 20%, almost a 20% increase from where they are standing right now in the last month. Right now, they have lost 7% of their value. In year to date, they are up 1%, and in the last 5 years, they are flat. And as you can see, the price tends to go up and down. And the question is, at least what I'm trying to look at is it time to jump in, or should we wait a little bit longer? If you like dividends, they pay $1.56 on dividends annually, which will be about at 3.22% at current prices, and they are scheduled um, to go ex-dividend on January 3rd. For those of you that don't know who Cisco is a tech company that focuses on providing network solutions and connectivity solutions, which includes cloud, software, security, and now they're jumping into AI. A lot of people are jumping into AI. So they are a big player in helping companies be able to be more efficient when it comes to communicating and working with their networks and their software. Cisco reported on November 15. They beat in EPS, and then they also beat in revenue. So why did they went down almost 11%? Well, part of the reason is because they revised their guidance for Q2. They were looking to 14.2 billion dollars on revenue, and they revised down to 12.6 billion to 12.8 billion, which a lot of analysts didn't like. Another thing that they mentioned is that in Q1 they had problems with supply, and the orders declined 20% from their largest customers, and that is also has creating a big backlog. So that is creating, and they're expecting for that to continue on Q2. That's part of the reason why a lot of almost every revision has been down for the last 90 days. That's 21 revisions down and 0 up. And so let's jump into the financials for the past 10 years. And before we do that, I just wanted to invite you to subscribe, leave a comment, and maybe press like or a review. Just I would love to hear from you. If I get something wrong, if you are investing and you have a better case for Cisco, please let me know. So I love hearing from you. As you can see, the revenue has been growing up steady, somewhere around 4 to 5% in the last 10 years, and earnings, even though there was a big drop in 2017, has been going up in the past 5 years about 5%, and in the last 10 years at 8%. The average profit margin in the last 5 years is of 22%, which is pretty nice. And for free cash flow, it's generally going up in the last 7 years for 7%, and for the last 5 years, 5%. Their free cash flow average margin in the last 5 years is almost 30%. Book value had a big drop on 2017 and 2018, so it has remained flat in the last 10 years. But in the last 5 years, it has gone up 8%. The average return on invested equity in the last 5 years is 30%, which is double of what I look for that. Return on assets is at 12%, and return on invested capital at almost 21%, which are good numbers. Dividend has been growing in the last 10 years about at 8%, but in the last 5 years it has been slowing down to 2.6%. Payout ratio is under 50%, which is pretty good. When it comes to debt, they have been reducing their long-term debt, which is really good, and they by almost 13% in the last 5 years, and they could pay off their long-term debt with their 1 year average of half year average of their free cash flow. Shares have been going down at 2.5% in the last 10 years and 1.7% in the last 5 years. So as we can see here, analysts are predicting that this company will continue to grow at 6.4%, and in the last 5 year average, it's somewhere around 4 to 8%. I will be using an average of 5. The average is 5.6%. I'll probably be using a 5%. And right there, this is just my opinion. This is not a financial advice. So I am just a YouTuber. I'm not a financial advisor, and you should consider this. But I personally, based on this growth, I will probably be looking at other opportunities if I were to hold this for a long term. So I will still want to go and look at the numbers to see if this is more of a value play, because if it will be a growth play, I don't like the numbers. If it was a dividend play, I wouldn't do that either. So let's go to multiples. Historically, if we look at the historical multiples, we take the trailing 12 months, multiply by the 10-year multiple medium, and also the average. The fair value of what the market has paid, it will be somewhere between $48 to $54 based on historical trends with this company. When it comes to payback time, this is when we take the free cash flow and grow it at 5.5%, which is what I'd be using as a growth rate. We'll be looking and we collect all of the free cash flows for the next 15 years. They add up to somewhere between $92 to $106, and this, of course, is not discounted. If we wanted to discount the earnings, growing them also at 5% and paying and the medium average, the medium PE of the last 10 years of 17, we will be looking at a price somewhere between $31 to $37. If we look at Buffett's owner's earnings valuation, we're looking somewhere between $63 and $72. And as you can see, all those numbers are all over the place, which it creates a little bit of a problem when trying to analyze this company. When we put all the numbers together, we're looking at a fair price somewhere between $53 to $60. If I were to do this, to buy this company as a swing trade or a value play, I will be looking for a minimum of 30%. So that will give me a average price, entry price, somewhere around $40. And right now it is trading at $48. So that is an interesting proposition for those that, so the fair number that I'm looking at here is somewhere around $56, which is close to what the analysts are predicting. For me to take that risk, I will probably need to, like I said, get into the 40s, which is not a crazy idea since it has been below or close to 40 three times in the last 5 years. So those are my opinions. I think there's better tech companies out there. If you disagree with me or if you have some comments, please put them down in the in the in the comments below. Please subscribe. Only 96%, only 4% of you guys subscribe, and I would love to hear from you. And I'll see you in the next video.